Welcome. In this video, where can XCN coin fall end? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. Currently, when we look closely at the price movements, we observe that it has reached a critical support level and is trying to hold in this region. In technical analysis, support levels are known as areas where an asset has previously attracted intense interest from buyers, where the price has stopped declining and often reacted upwards. These are the areas that both short-term traders and market participants with long-term strategies watch carefully. In the current situation, if the price finds equilibrium at this level, it could be a harbinger of a potential uptrend. This horizontal support area observed on the chart stands out as an area that has been tested many times in the past and where buyers have come into play strongly. A psychological defense line usually forms in such areas. Long-term consolidations, especially at these levels, build confidence among investors. When the price comes back to this support level, investors who have bought in the past tend to reopen positions. At the same time, the fact that the price seems to be reacting upwards again from this point may indicate that market participants still consider this area as a strong demand area. However, this initial reaction from the support level, although a positive signal, needs further confirmation before it can be interpreted as a permanent reversal signal. Because it is possible to encounter so-called false breakout or fake bounce situations from time to time in the market. The price reacts momentarily from the support level, but when this movement is not sustainable, it may re-enter the downtrend. Therefore, it is better to evaluate not only the initial reaction, but also the subsequent structure, volume support, and technical indicators. In order to assess the strength of the reaction from the support level, it is also necessary to look at candlestick patterns. In particular, patterns such as pin bars, doji, or bullish engulfing, which form in such areas, indicate that buyers are starting to take control. If such patterns are forming at the support level, and the subsequent candles are starting to form higher lows and higher highs, this could technically be the first steps of a reversal structure. This means that the market is increasingly likely to change direction. It should also be carefully watched if the price starts to form a trend reversal pattern with the reaction from this level. In particular, double bottom, reverse shoulder head shoulder, or round bottom patterns are often formed at support levels and can often herald strong rallies. If such a pattern starts to form and the neckline is broken, a serious change of direction may occur in the market. In the current outlook, the price's reaction from support may be signaling the beginning of such a formation. Of course, like any technical analysis interpretation, this scenario involves certain risks. Although the price seems to be making an upward move from this level, it is necessary to carefully observe the market's behavior over the next few sessions to understand whether this move is sustainable. In particular, a possible close below this level or a strong break to the downside would indicate that this support zone has lost its validity and selling pressure may increase further. But we cannot decide the analysis only with support. Let's look at other metrics. Stay tuned. From a long-term technical analysis perspective, price action is in line with the Elliott wave theory. According to the current outlook, the market has completed the first wave on a broad scale and may now be positioned in the second wave of correction. The Elliott wave theory is a powerful theory that argues that prices in financial markets move in certain psychological cycles and patterns. According to this theory, prices exhibit an impulsive structure consisting of 5 main waves, followed by a 3-wave correction that brings them to rest. The current structure may be pointing to the second wave of this broader perspective. That is the correction phase. The first wave is usually the initial phase that signals the market's entry into a new bullish cycle. In this wave, the price is slowly moving upwards from the lows, but investors are not yet fully convinced. Often volume may be low, but technically higher lows and higher highs are formed. With the completion of this structure, the second wave begins. The second wave is the correction that follows the first wave and is often a period when traders hesitate and ask, was this rise permanent? At this stage, the price gives back a significant portion of the first wave's gains, but this correction should be considered as part of the bigger picture, as the third wave is usually the strongest and most voluminous bullish wave. This is where Fibonacci retracement levels come into play. In technical analysis, the depth of correction waves is often measured by Fibonacci ratios. In particular, the 0,618 and 0,786 levels are known as areas where prices often touch and react strongly when correcting. Analyzing the current structure, we can see that the price retraced towards these ratios during the second wave correction and tried to hold on to these areas. This suggests that these areas may also be areas of strong demand. The 0,618 level is not just an ordinary ratio in technical analysis, but a mathematical threshold that represents the natural rhythm of the market. Market participants may consider these levels as a natural reflexive buying opportunity due to their past experience. Therefore, the price tends to show upward reactions much more often when it reaches this level. Likewise, the 0,786 level is a deeper but still considered valid correction area. Especially during periods of high volatility, the price may pull back to this area and then make sharp bullish moves. The current technical structure shows that the price is oscillating between these two important zones and has reached the decision stage here. If the price finds clear support in one of these zones and makes an upward reversal, this could signal the start of the third wave. The third wave is generally recognized as the strongest and fastest moving structure in Elliott wave theory. During this wave, both individual and institutional investors enter the market in large numbers. Volume increases significantly. Market participants develop a clear sense of direction, and trend movements are more easily formed. Moreover, the psychology of the market during such deep corrections is also quite decisive. During the second wave correction, some of the market participants may panic because the price appears to have declined significantly. However, in the context of Elliott wave theory, these declines can be a harbinger of big rises. Investors who are patient and strategic can turn such pullbacks into opportunities. This is because the third wave can often advance at least 1,618 times as far as the first wave, offering a potentially high return. As a result, the price seems to be currently in the second correction phase of the Elliott wave structure, which is taking shape between the 0,618 and 0,786 Fibonacci levels. These are historically strong support areas, and there is a high probability that prices will react upwards from here. Of course, in order for this to happen, it is necessary to pay attention not only to the numerical ratios, but also to the general market psychology along with other technical structures. If a reversal from these areas materializes and a third wave of action begins, this could signal the beginning of a serious uptrend in the long term. A closer look at the charts shows that the Bollinger Bands have narrowed significantly recently. In technical analysis, this narrowing usually signals impending high volatility. Bollinger Bands are a volatility-based indicator, consisting of upper and lower bands that are dynamically calculated based on the standard deviation of the price. As the bands move closer together, a squeeze forms in the market, which often heralds a breakout move. The fact that the market has now entered this contraction phase strengthens the likelihood that the price will make a sudden and sharp move in the coming periods. This type of band tightening indicates that a decision phase is approaching in the market. Traders are uncertain about direction and trading volume may be low for a while. However, this is often the calm before the storm. This narrowing of the Bollinger Bands indicates that the price is stuck in a certain range and is gathering energy. When market participants notice this tightness of the bands, they start taking their positions in advance for a possible breakout. This can lead to spikes in volume and wide price swings as a reaction to the initial move. The narrowing band structure implies that the price is being stretched like a spring and will soon release in one direction or another. Although this direction cannot be known with certainty in advance, some technical clues can help us make predictions. For example, if the price has started to pinpoint the top or bottom of the bands, if volume is increasing, or if momentum indicators are starting to show a certain trend, it may be possible to get an idea of the direction of the breakout. However, the general rule is this: the more the bands have narrowed, the stronger the price movement that may follow. It is necessary to watch the Bollinger Band for narrowings. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.